Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. The video I have prepared for you today is the third in a series of videos where I'm going to be looking for value in the 10 major sectors as reported by Standard & Poor's. And as I often say, it's a market of stocks, not a stock market. But as I'll show you here in a moment, the market itself, if you were using things like the Russell 3000 or even the S&P 500, you will see that the overall market as a collective is really overvalued. So my objective here with these videos is to find good value in each of the sectors, despite the fact that the markets themselves are overvalued. And to do that, I went and created a bunch of screens where I screened for value in each of the sectors. Now, the screens I created are very specific, but you can do a lot of different things with the screening tool, the FastGraph screening tool. But these are what I'm going to show you here in a moment is just some research candidates, some stocks that look fairly valued. Just because they made the screen doesn't mean they're going to be good investments. You're still going to have to conduct your own research and due diligence to see. But let's go ahead and turn to FastGraphs and see what I've come up with here. Now, first of all, I've logged into the FastGraph tool here, and we start with the dashboard. And I want to make a couple of comments about the FastGraph dashboard. This shows you any recent searches you have been making. These are some that I've made. Then you got some preset screens here that are already done, and you can view a lot more of them by clicking this button here. And then if you have a portfolio, you have a portfolio summary here, where you can see what the portfolio you were looking at. This is just makeup. This isn't real. But it's just one that I've got here as a sample for you and just shows some different companies. And it gives you your top gainers, top losers, and top traded for the day. But then, as I alluded to, you've got these market ETFs here. You've got the Standard & Poor's 500, and you also got the Russell 3000, which is up here now. And I'm going to be talking more about that, but what I want you to note is just how highly valued they are. Now, going into and start looking at those two big ETFs, we can see the S&P 500 ETF Trust here, or SPY. And I want to make a point. What FastGraphs is all about is identifying the intrinsic value behind the investment versus the market value of the investment. And that's something I think, the more comments I get, I find that people really are misunderstanding. It just use your powers of observation. We've got 20 years of history. That's as far back as FastGraphs goes here. And what I want you to note here is the Standard & Poor's 500 ETF has traded between a 15 multiple or PE ratio, which is the orange line on this graph, and here's times where it traded right on that line, to a 18.91 PE, which is the blue line on this graph. It represents a PE of 18.91. Now, clearly, you can see that for the majority of the time, the market was trading somewhere between these two numbers. That doesn't mean it was perfect, but it is just by looking at this graph. Here's where the market was trading below the 19. Here it was below the 19. Here it was significantly above it and corrected. And today we see it clearly well above, with a PE of 25.89, well above its market, more neutral market, 18.91. So this would tell us that the market's overvalued. The growth rate of the market with some cyclicality has been about 8%. Now, we can also go and look at the other ETF that I showed you a minute ago, which is the Russell 3000, iShares Russell 3000 ETF, and you get almost an identical picture. The normal number here is 19.59. Now, keep in mind, these numbers are mathematically correct, but they're ranges. So once again, we've got between 15 and we're going to even call it 20 times earnings, which is a normal valuation for the market, whether you're using the Russell group of 3,000 stocks or the S&P of 500. Now, the Russell 3000 isn't expected to grow as nicely as the S&P is expected to grow. I want to point out that to you too. The S&P is expected to have some pretty extraordinary growth. Now, part of that is the way they build this index, and it's really heavily weighted with the top tech stocks like Microsoft and Apple, and now NVIDIA is being added, and so on. But you're looking at still a group of 500 stocks here. But within this group of 500 stocks, there are stocks that are fairly valued. And I thought it'd be worth taking a moment to look at that. One of the things we have in the portfolio section of Fast Graphs is we have this thing called preset portfolios. So if I went into the S&P 500, okay, and looked at a view that I call value that I've created for the S&P 500, what you've got here is a look at all the 500 stocks. Now they're listed 50 at a time, but if I click on this PE number, okay, I can see that if I'm looking at that, there are a lot of stocks in the S&P 500 that have a PE below what I consider to be normal, which is 15 that I talked about a moment ago. Okay, so I can go to the second group of 50. That's the first 50. And I still have stocks now we're at about 100 of the S&P 500 that are trading below a PE of 15. So if I go ahead and go to the third, now we're at 150, 101 to 150 stocks, and I still have the majority of them trading more or less around a 15 PE, but they're starting to get above it, starting with Citizens Financial here and so on, and getting up into higher. Now, earnings yield is also a factor that applies to this. I like a 6.5% to 7% earnings yield, which basically is that 15 PE, but anything above 6 is at least near fair value. Okay, so we've got roughly a third, or a little, maybe less than a third, of the S&P 500 stocks that are actually approaching fair value. So what I did was I went into the screening section of Fast Graphs, when I'll move into that, and I created a screen. Now, one of the things you can do with Fast Graphs is there's this top up here that says created. I can click on that, double click on it. All right, and I got the newest screen I made was November 5th, 2024. Okay, but I also have screens on here. I created screens for all these different sectors here, which I made a while ago. So we're going to be looking at consumer discretionary for total return. Okay, that's the screen that I'm going to be covering in today's video. Now, I've got 6 items in general, 1 in historic, 2 in estimated, and 2 in regions. The point is I've set parameters for this screen. And so again, I want to repeat what I said in the last video. The only stocks that are going to come up are the stocks that meet these screens. So it doesn't make any sense to ask me about other stocks that you might think look good or might be attractive in the consumer discretionary. If they didn't meet my screening criteria, they're not going to show up. And what is that criteria? Well, first of all, I'm looking for country of incorporation. I said any here, but I actually did limit it to Canada and the US, which I'll show in a moment. I'm only looking for the consumer discretionary sector. Okay, that's the other screen. I'm looking for stocks. I want to see the PE, so I checked PE, but I didn't put any restrictions. But I do want, as I mentioned a moment ago, an earnings yield of at least 6%. That gets me close to a 15 PE and close to fair value for most stocks. And then I want stocks that have at least a 60% persistent growth rate. In other words, they grow their earnings 60% of the time. They might occasionally miss their earnings estimates. So that's another criteria that I've added into the screen. So those are my criteria, the 6 criteria that I have under general. Under historic, I simply want positive growth over the last 5 years. Not a big hurdle to cross, but that's what I want. And then for my estimated screens, I want a total return greater than 5% and earnings growth that's positive. That's all. I'm just looking for those. Again, the simpler you keep a screen, the more valuable. And as I mentioned, the regions that I picked are US and Canada. So once I run this query, I end up getting 15 stocks. Now, what I did with these 15 stocks is I went to this add to the portfolio feature, and I named and created a portfolio. And I went ahead and already opened that here, so let me go ahead and just show it to you. So the portfolio I created was consumer discretionary, and I got these 15 stocks that came up. Now I'm going to go, I've got my view listed here. Okay, so I've got 15 tickers. Now these are stocks, if I look at the PE ratios, that all have PE ratios under 15 except for Yeti Holdings and also Gentex. So I've got a couple here that exceed the limit by a smidgen, but I've also got a bunch of them here that are well below a 15 PE. I've got earnings yields that range from 6.12%, which is above my 6% number, all the way out to 14%. Now, a higher earnings yield would indicate better value. It's really that simple. But again, we want to look at growth and consistency. So these are just, in essence, barometers to let us know whether or not we've got some decent holdings or not. So let's go ahead and start looking at these stocks. Let's go ahead and click on the symbol. Now you can do it quickly in Fast Graphs, but I want to go through the whole portfolio here for you. And again, I want to point out before I show these, just because they made the screen doesn't mean they're going to be great investments. But it does mean that there are stocks in this sector that are reasonably valued, especially relative to the much riskier stock market. So let's go ahead and look at Gentex. Now it has a PE of 16.3. It was the highest PE, as I mentioned. You can see if by just looking at the graph, a 15 PE is this orange line here. And then the blue line is a normal PE of 21.3. Now what a normal PE is, it's a trimmed average of the market. Okay, and if you go ahead and click on this, it represents the calculated multiple at which the market has tended to value the company over time, calculated by a trimmed average of annual PE values for the period shown on the graph. Now that's critically important because if I change this number to a 14-year graph, that normal PE changes dramatically. It drops down all the way to an 18. But again, use your observation. I've got a 15 multiple. There are times when you could catch this stock below that multiple, and I've got an 18.18 multiple in this time frame, and there are times when you could catch it trading right at that multiple, but there are also times when it gets modestly above it, and even times when it gets way above it. Now, clearly, when the stock gets way above its normal multiple, that usually ends up being a bad time to invest in the stock. Obviously, if you invest in Gentex up here at a 35 multiple, which it was on February 4th, 21, and held it till today, you'd be losing money owning the stock. And the company itself has had some cyclical earnings growth, but it's probably generally grown during that period of time. Okay, now again, if I change time frames again, I'm going to get slightly different calculations of the normal PE, different growth rates, etc., because you're averaging data over a different time frame here. That's what makes Fast Graphs so special. They allow you to run through these valuation criteria almost instantly just by clicking a button. Okay, and you can see whether growth is accelerating, staying the same, and then how the market has been valuing it over whatever period of time you're looking at. Now, when I'm doing a high-level view like this, I always go to max because I learn some things. I can see the company has periods where it doesn't grow very much. This is the recession of '08. Periods of time where it grew very consistently, and again, had a period of down earnings or flat earnings, which is also when the valuations were highest, but also the most vulnerable, as you can see. And then they started growing again. So you'd go into forecasting and look. Now, the company is expected to grow by double-digit rates going forward by about 9 analysts that are following the stock. And with Fast Graphs, you can also just point to the 15 PE, and this is what your rate of return would be if it achieved these earnings results that these analysts expect, and if it traded at a 15 multiple. Now, if I go to the normal multiple, which for the last 5 years has been 19, I just had a question on this. When you're looking at historical normal or historical growth rates, there's always a drop-out window. And so you can see what the PE ratios have been, all these different time frames. And you can pick one that you think is reasonable. But if I'm using this one at a 19.5 PE, I could stand to make some really nice rates of return if I bought and held this stock. Now, historically, that's not out of the question because the market has put it at a PE ratio in that range numerous times. The question is, do you trust it? Now, it's a nice company. It has almost no debt. It does pay a dividend. It hasn't grown the dividend for the last several years. It's not expected to. It's auto parts and equipment. Now, another thing with Fast Graphs, you can always go into the external links and go to the company's corporate website. If you don't know what the company is, you could go into their website and spend a little time and learn some things about what the company does, what businesses they're in, etc. Okay, so that's another nice feature of the tool. So anyway, that's Gentex. I would like to buy this stock at a lower valuation if it was me. It does have some nice growth forecast, but again, I want to remind you of the cyclicality here. The next stock is Genuine Parts. Now, I did a video on this one, and I even had a comment saying I was wrong about General Parts. It was not. Okay, General Parts was a very overvalued stock as early as January of 2023, and then we had a correction. It got overvalued again, a correction. It is expected to have a negative year this year, which is, not uncommon. There are plenty of times with what I would call a moderately cyclical stock. But remember, its earnings persistency is at least 60%. Its average 6.74% growth rate, if I shorten the time frame to 13, it's still averaging about 6%. If I shorten it to the last 8 years, which includes some estimate, it's still around 6%. So my point being is that's something I might want to rely on, about a 6% growth. Now, the analysts are only expected 4.49, and at a 15 PE ratio, that wouldn't give you a giant return, but it would still give you a nice return of over 8.5%. If we went in and looked at the normal multiple and calculated our future return based on an 18 or 19 multiple, then this stock could generate a 19 or 20% rate of return. Okay, and it has an analyst scorecard that has been excellent on the 1 year or has been very good on the 1 year and excellent on the 2 year, where it's always exceeded the estimates. Now, I do want you to note, using this tool, that analysts have been lowering their estimate over the last 6 months, 3 months, and then most previously, but then they've raised it again from the last most recent estimate. They were expecting $8.42 for 2025. Now they're saying $8.44. They were expecting $8.11 for 2024, which is coming up in a month or so, and now they're saying $8.12. Again, these numbers are never going to be perfect, but they're always going to be very helpful, hopefully. So that's Genuine Parts. This is a very high-quality company, BBB rated, and it's been a consistent performer. And if you buy it at reasonable valuations, and here's a 16 PE, even at this level, you make 8%, you get a pretty decent dividend record. And you can always check that by going into the performance results of Fast Graphs and see what the dividend growth rate has been. And it's grown about 6%, which is consistent with how fast the company's grown. The trick here is to buy it when it's cheap. If you buy a stock like Genuine Parts when it's undervalued, even if it comes back to value, you end up making 10 or 12%. This is why I keep getting a question, I think from the same person. Show me, for the love of God, can someone show me why valuation matters? It matters a lot. Well, it does matter, because here, if you look at Genuine Parts and you buy it here when it was overvalued in 2014 and held it till today when it's now fairly valued, you make 4%. In contrast, if you'd have bought it a couple of years earlier, now it's a different time frame, at let's say a much more attractive valuation, and held it till today where it's fully valued, you end up making almost 8%. And then if you get really lucky and smart and can buy it at its low point, which is obviously impossible other than by luck, then you can make over 20%. That's why valuation matters, and that's why valuation matters a lot. The next stock on the list here is Jack in the Box. Now, this is an interesting one because it is obviously a restaurant. They have an enormous amount of debt. During COVID, they clearly had a massive drop in stock price, but interestingly enough, because Jack in the Box had a lot of freestanding buildings, they weren't stuck in malls and so on, they ended up earning some decent money during COVID. Okay, but it is a quasi-cyclical stock, and there are times when the market valued it real high, and those periods, like these high valuation periods, are always vulnerable to a catalyst of something like weak earnings. And of course, their dividend record has been a little spotty. The one thing I'll say about this company, or for this company right now, it's extremely cheap. Okay, it's currently trading at a blended PE of 7 with almost a 4%, 3.7% dividend yield, and good growth being forecast. So if you were to calculate what that would mean at a 15 multiple, and again, there's no dividend being estimated for 2027. It doesn't mean they're not going to pay one. It just means no analyst is projected. When you can see there's only 2 analysts for 27. But if I go where there are analysts, and by the way, this has a September fiscal year. If I go looking at the 2026 where there are 10 analysts, this could end up generating a 58% rate of return at a 10 multiple. But if I go to the normal multiple for this stock of 16 times earnings, that could even be a 64% annualized rate of return. So Jack in the Box is very, very cheap. It has traded at 15-ish multiples numerous times in the past. So you could either see this as a great opportunity or great risk. But so many of you live and die by where the stock price goes. And what I'm interested in is where the business is going. And that's represented by the orange line on the graph. So I can buy this business at a price of $47 that appears to be worth at least $90 or more on an intrinsic value basis. If you're willing to take that risk, even with their high debt, then that's something to consider. The next one here is Legacy Housing. Now, housing stocks notoriously are what I call blue line companies. The market never just seems to value them at much over 10 multiples, at least not till recent. You can look at all the majors, Pulte Home and many others, and you're going to see that. So this stock is trading at a blended PE of 11.6, pays no dividend. It's grown at over 13% a year. So if you'd have bought this back in January of 2019 and held it till yesterday's price, averaged 15%. But again, there's a lot of volatility in between that. Forecast for the future is this company to grow earnings at 11%, but trading at that normal discounted multiple would give you a nice 8% rate of return, but again, no dividend and at relatively high risk. So the next stock I've got here is LGI Homes, again, another home builder, and we see almost the identical picture here. We see a 10 multiple-ish being traded at. We see some real nice growth, but we see some cyclicality. It is expected to grow very nicely at about 20%. But again, at a normal multiple of 8, there wouldn't be much rate of return here. Now, looking at normal multiples on this stock, the highest multiple I can see here, just by a quick glance, is about 10.5, or actually there's one at 11. Okay, so if you put this at an 11 multiple, then you could stand to make a pretty substantial number. But again, you have to decide what PE multiple you would run your calculation on. And looking at this stock historically, I kind of like the idea of a 10 multiple or less as a real good benchmark. So with that said, I would go here then. I would go into the normal multiple, and I would simply look for a period where it was, now here's 9.95. That's about as close. Here's 10.08. Okay, so that puts it in at a 10 that draws the blue line here at a 10 multiple. And at a 10 multiple, you can make just under 10% because it'd be a little overvalued relative. But we do have good growth potential here. Okay, again, you have to decide if you're looking as a total return investor, whether that makes sense for you or not. The next stock on the list is Leon's Furniture. Not a lot of growth, has periods of growth, quasi-cyclical, a little bit of an erratic dividend record. It is a Canadian company. And again, if you're not familiar, you go into the website and you can see what they do. They're basically a furniture company. Okay, simple as that. The stock has rallied up to what I would call a normal PE ratio, trading just above its normal 13.74. So if I go to forecasting, we're not expecting a bunch of growth here, but looking at the normal multiple, the stock looks like it would be overvalued. So I wouldn't personally be interested in buying the stock here. I might have been interested in buying it when the price was trading at a much more attractive valuation from a long-term investment point of view. Mattel is a very interesting stock. Of course, Mattel had some real earnings problems even prior to COVID. But since coming out of COVID, they began to rebound. They completely eliminated their dividend. You see there's no white line or green shaded area. These are things I'm learning just by looking at a quick glance of fast graphs. It did have some growth, and when it did grow, it had some pretty good stock performance, and then the earnings collapsed, and then we had this really abysmal performance. I'm not hitting tops or bottoms here. I'm just generally getting the middle where we'd have lost more than 75% of our money over this time frame here. Now the stock looks like it's got some growth potential going forward. The analyst scorecard, however, is very unreliable, so I wouldn't put a whole lot of credence into that. Long-term growth is supposed to be higher, expected to be higher, but again, this would be a tough one for me to invest in, but it might be something that would be of interest to some of you. Do your own homework and due diligence. Now, the next company is MTY Foods. They went through a COVID collapse, but they've recovered very strongly. Again, if you don't know the company, you can go just directly into their website and learn what the company does. They have different restaurant chains and different food products, and the company going forward is expected to grow at about 5 or 6%. The normal valuation on this stock has been higher than my preferred 15 PE. But again, you got to assess that and see whether you're willing to invest in the stock that could go up to a 15 or even as high as a 19 PE based on historical norms. The next stock here is Spin Master. Now, this is one that I had to go look up. I go to the corporate website, and They have, I guess, all these different toys and games, which is where they get the symbol toy. Okay, and so you can look into this, and maybe this is a company that's interesting. What I find interesting about it is coming out of COVID, they had some bad earnings and the stock price reacted. Since coming out of COVID, the stock price has recovered. They had a down year in 2023, and that kind of hurt their stock price. They're expected to recover this year, and the stock is starting to show some promise. Looking at from a forecasting point of view, it could be a really good rate of return generator at a 15 multiple. At a normal multiple, it could even be better. So this is one that you might want to take a closer look at. The company has virtually no debt. They just started paying a dividend, and they've been growing that dividend at a very healthy rate. But the payout ratio, as you can see, is still around 10% or so, maybe as high as 15. So this is one that might be worth taking a further look at. It's a small cap with low debt and a Canadian company. Now, Whirlpool is one that I own for my dividend or income investors in my money management firm. It's got a very high yield. They've maintained their dividend. The company has suffered several years of earnings drops, which obviously affected the stock price. But going forward, analysts are expecting a recovery in growth, actually 20% in 2026. This would give them an opportunity at a 15 multiple to generate very nice rates of return. And even at their 8 multiple, it would be a 5.5. But again, I used a drop down here. That 8 multiple is kind of on the low side. So it's a very conservative number, but I could maybe look at a 10 multiple, and that would be more normal, let's say, and that would give me a 17 or 18%. The real allure here is the fact that it offers a 6.2% dividend yield. And the valuation is definitely low. I think the stock is going to recover. There's a lot of reasons. Now, by the way, you can go into the external links here and go into things like, which I subscribe to, like Morningstar. And Morningstar gives it 4 stars, and they give it a fair value of 133, and the price is currently 112. And they do expect this company to recover. Okay, and it's basically a consumer discretionary that's been around forever, and many people have Whirlpool appliances in their homes. And then this one I really kind of am intrigued with as a growth stock. It's Yeti. Yeti was one of these stocks that the market just loved. What I call the definition of appreciation is when the other person appreciates the stock more than I do, and everybody was really appreciating Yeti here. They did obviously have a break in earnings with 2 down years, and we see the stock collapse from a high of 108 down to the current $41 it's currently trading at. But looking at forecasting, growth is expected to be double-digit again. That would easily command a 15 PE. Now, the 25 multiple, I believe, is a little high, but that is historically what the stock has traded at. But if it did get as high as 25, then the rates of return would be extraordinary. So again, this is one that has very low debt. It's got a small market cap of $3.5 billion. I like this stock as a total return stock for especially younger investors that have some need for long-term growth. Again, it's Yeti. It's the coolers and cups and so on, bags. The company's well known for the cups they make and so on. And so it's kind of an interesting little stock, and again, an interesting little small stock. Anyway, there you have it. That's Chuck Carnevale, co-founder of FastGraphs, bringing you the consumer discretionary stocks that appear reasonably valued. Now, these are discretionary stocks. We saw what happened in COVID with several of them. I'd say do your due diligence. I don't know if there's a lot of real gems here that I'm personally interested in, but there may be some in here for you. But I'm going to go through each sector and just show where there is value, but also I want to point out some of the risk of those. If you like the video, give me a like and ring the bell so you're notified of other videos coming up. Join our YouTube channel if you haven't already. Give me a follow and take a look at FastGraphs, the Fundamentals Analyzer software tool. I've been using it to run money for a long time, and I wouldn't even dream of investing in stocks for myself or clients without it. Thanks for watching, and we'll talk to you again real soon.